I want to talk with you for a moment about savings. So there's several aspects of savings that are important to recognize. I've already covered in a previous video about emergency funds, and emergency funds are part of the savings that you need to be doing on a regular basis, maintaining somewhere around 3 to 6 months of your average monthly expenses to have that put aside as a reserve. So in the event that any kind of crisis situation comes up, a medical situation, that you have a job loss, a transfer, you need to move to a new area for a job, for a different job, or a transfer of your job. There's a whole range of things that can happen, like home emergencies, where you need to provide a deductible of 500, 1,000 or more dollars for repairs on your home or your vehicle, these type of things, and many other things. So you really need to make sure that you have an emergency fund. That's a part of saving that you should be allocating in your budget every single month. So do not neglect your emergency fund savings. It's vitally important. If you do not have your emergency fund and you're not currently saving for that and being prepared for a crisis when it happens, when those crises happen, and guaranteed they will happen, when they happen, you will definitely regret that you have not prepared, and you will feel the hurt as a result of that. But I want to talk about a couple other aspects. One of those other aspects is you need to have some personal savings for personal spending. So you need to set aside in your budget every month some money that you can use, some entertainment expense. Maybe it's having a membership to Netflix. Maybe it's renting Redbox videos. Maybe it's eating out occasionally. Maybe it's just buying frozen pizza and warming it up in your oven at the house, and having popcorn and having a movie night with the family. I'm not sure what it is, but you need to, especially when you're in your debt elimination stages of your at this point in your financial plan. You need to be definitely budgeting in, because you will spend this money. You will spend money on apps. You will spend money on videos. You will spend money on a lot of different things. Maybe occasional eating out. Buying a candy bar, buying some soda, a whole range of things that you may do. And if you're not planning for those in your budget, then they're going to get out of control, and you won't discipline yourself to limit that to a certain amount. So it's very important that you are planning so that you can have little things that are rewards, little things that are part of the enjoyments of life that you need to keep you on track. And willing to continue to work, because those little things are incentives to tell you, hey, I want to eliminate all my debt so that I have larger amount of disposable income. That is income that I can use in any way I want, that I don't have to actually pay bills with, or debts with, that I can actually spend it at my own leisure. And so the less amount of debt you have, the greater disposable income you will have. So pay off your debt, but in the process, make sure you're budgeting money for personal spending, so that you can have, call it an allowance, whatever you want, just like you would do with your children. Call it anything, just a fund, whatever. You just call it what you want, but just make sure you are putting aside some money. But I want to talk about another third area that's of savings that is important, and that's for saving for investing, because you need to be planning every single month. Every time you're paid, whether it's monthly, whether it's weekly, bi-weekly, however you're paid, you need to be planning that you are automatically taking a portion of that money. You are allocating that in your budget, that you're setting it aside as savings, as an expense, so that you will then put that money away so that you can buy investments that are going to produce cash. Now, these are real, true assets. We're not talking about buying your personal home or car or a vacation home or a boat or a camper or RV or a motorcycle or any of those other toys or amenities of life that you want to have. Those things are liabilities. They take money out of your pocket. They will eat you if you stop paying for them. Whereas a true asset is something that puts money in your pocket every month. It is something that is cash flowing to you. In other words, after that item, all expenses from the income of that item, it's producing income, and then from that income, it pays the expenses of any loans that are on it, which we call big good debt on cash producing items. So it pays the expenses of the loan to be able to own the item. So whether it's a piece of rental property or whether it's a business that you would own, so it pays the expenses associated with that, any of the management fees, any of the things necessary that are expenses related to that investment item that you own. And then after all expenses are paid, it would bring to you, flow into your personal budget, a net profit, a net cash flow. And that net cash flow is what distinguishes it as an asset from the liabilities that most people think are assets. Most people become poorer and poorer because they buy liabilities thinking they're assets. We'll cover that later in some other videos. But I just want to identify this quickly. You're saving money not to go buy toys that go down in value and they do not produce cash flow. Instead, they make money flow out of your budget to pay for those items. So you're going to have to pay for insurance. You're going to have to pay for upkeep. You're going to have to pay for taxes and a whole range of other things, licensing or whatever it happens to be for the particular toys that you would think that is a asset, but really is a liability. So we're looking at saving specifically for buying assets, things that produce cash, pay their own expenses of ownership, and then put extra cash, net cash flow in your pocket. That is the kind of asset, that's what you want to be saving for. So it may take you a bit of time to be able to save for your down payment. But as you are putting away money continuously on a regular basis, being disciplined about it, intentional about it, before you know it, you will accumulate a sufficient amount of money, as well as the knowledge in the process of that saving that money to buy the asset. You will be accumulating knowledge as you choose to educate yourself on how you can more successfully, at a better lower investment, a better advantage for yourself with higher leverage that you could use. And I'll talk about leverage in a later video, not right now. You will then be able to purchase that asset quicker. And then the cash that comes in, flowing into your budget from that asset, instead of going and spending it, increasing your standard of living, take that cash, put it in an account so that it can grow along with the other excess cash you're saving for buying investments. And then together that will increase the speed, or what we call collapse the time, which we could shorter in time, that you can buy your next asset. So then as you have the second asset, and both of those two assets are flowing cash into your budget, plus you're saving from your personal excess cash, you combine, now you're going to collapse the time even more, so it will be even shorter. And then you buy that next asset, and then the cash flow comes in, and eventually it collapses the time so fast that you're buying assets, and then before you know it, the income coming from those assets will exceed what you're making at your job, and then you're going to be able to turn in your resignation, say goodbye to your employer, and you're going to be able to live on the assets and the cash that they're producing for you. So this is why you want to save it, because ultimately you don't want to save for just saving's sake. And I want to go into that here in just a second. I want to show you a little chart that I put together. I won't share my screen, but you want to save for the purpose of achieving financial freedom. Because here's what happens if you save. This is a very important thing that I want you to catch with this chart. Let's see, here it is. So I want to share this. So as you notice here, I got here savings, and I've got here CPI. That's the Consumer Price Index, which is what the government uses to track the rate of inflation. So and so I just plugged inflation there as well, so you can see that that's what we're talking about. So we're talking about the rate of inflation. Right now for 2019, the rate of inflation or increase of price of your items is 1.71%. Whereas if you were to go to a bank and you were to open a savings account at your bank, you may be able to find a savings at 0.25%. Most of them are less than that. I know that you can get money market funds that are more. I've talked about that in some previous videos. You can go get, I happen to have a number of different money markets with different institutions, some that are brokered, some that are not brokered, and those are running somewhere around 1.85, 2.46. It just depends on what's happening in the economy at the time. But there are a considerably larger amount of growth on there than what your average savings. I also have a bunch of savings in different institutions, both business and personal. And in those savings accounts, I'm getting about 0.10 between multiple financial institutions that I have the different savings accounts in. And so that rate, if I just plugged in here 0.10, 10%. So if I took $100,000, actually, let's take this. I was going to use that for an illustration on a price of a house. But let's see. Let's take $1,000, and we're going to do $1,000 in both of these. So let's say you had $1,000, you got a bonus at work, you got a tax refund, whatever it happened to be, and you dropped that $1,000 in a savings account. 1 year later, at the current savings rate of 0.10%, you would have made $1. That's not very good, because that's 1/10 of a percent. It's not even an actual percent. So therefore, you're going to be making on $1,000 $1. That's terrible. Let's do it this way. If you take $100 and at 0.1% at the end of the year, it's so small, I would have to actually increase the decimal points in order for you to see the fractional growth that you would take place there. So you are really not making, in addition, interest growth on your savings accounts is taxed by the US government. So in addition to the abysmal growth that you get on it, you also have to turn around and pay taxes. Now, granted, for most people, the growth on their savings account, that interest is so minimal, it's so abysmal, it's embarrassing that you end up, it figures into your whole tax liability, and it doesn't increase your tax liability any, just because it's so negligible that it's not really much worrying about, even though you're supposed to file it along with the other with your taxes in the spring each year. So let's just make a comparison. So let's say we take $1,000. Let me put another zero on here. $1,000. If you were to put that in the savings for 1 year at 0.10, let's put it back up to 0.25%. Okay, so we want to actually change this from being 0.1%, and we're going to change this to 0.25%. So we can make a comparison so that you can see what would happen with just saving for saving. You're not going to be able to save your way to wealth. There may have been a time in which people would do that kind of thing, and they would save and accumulate a bunch of money over time and never spend it, and would save huge amounts of money. And then when they die, people would be amazed at how much money they had accumulated. Well, the reality is your savings in the bank is going to give you such little return that just savings like that is not going to be able to actually save your way to wealth. So if you take $1,000, put it in your bank, and save it at 0.25%, which is 0.25%, which is higher than a lot of banks are actually providing with a regular savings account, you're going to make $3 at the end of 1 year. It would take you forever. Here's what's terrible. So the U.S. government tracks the CPI, inflation rate. And so when we look at our current inflation rate of 1.71%, at the end of the year, that $1,000, what you would have been able to buy 12 months ago, with that $1,000 will now cost you $1,000 and $1,017. So while you may gain $3 sitting in the bank, the actual cost of goods will go up $14 more than what you actually gained as an earnings in your savings account. So while you gain $3, the cost of goods goes up $17 at the end of 12 months. So that really is a losing thing. And over time, the gap between the amount of money you earn in your savings rate compared to the rate of inflation growth or the cost of goods becomes wider and wider and wider with time. So therefore, if you want to be able to save effectively, if you want to be able to save for growth, let's say you want to save so that you're going to be able to buy investments, or you want to save for an emergency fund. My suggestion is you find a good money market fund. That could be through a brokerage company, someone local in your town. It could be through a brokered money market funds through your local bank, or it could be that your bank has a good money market fund. A lot of them online, a lot of the large credit card companies, which are banks, lending institutions, they have money market funds that have great rates for growth, and that makes it very valuable for you to be able to put that money in, so that you're continuing to grow while you're putting and accumulating additional cash. So if you want to get a rate that is higher than the rate of inflation. So when we talk about saving for retirement, so just saving in your savings account, you're going to be losing money over time. You will save your way to the poorhouse by just saving and putting money in a savings account. You need to put it into something, some type of investment that's going to yield a higher return than the rate of inflation. So a really conservative, for someone right around retirement or already retired, might be a 3, 4, 5, preferably more than 4% growth. So that could be some really good bonds. It could be a combination of really good CDs, depending on what the rates are offered. It could be a combination of mixing that with a diversification of other stocks and mutual funds, ETFs, that will give some additional growth. It leaves a little volatility that way, but you got a larger portion in something solid like bonds and CDs. So you got a combination of the stability and lower growth with also something higher growth, so that you're getting growth that's higher. One of the reasons why you need to do that is because you recommend, the financial industry recommends that you do not withdraw more than 4% from your retirement funds once you start living on those funds. And if you're withdrawing 4%, you really, if you don't want your money to have an expiration date, you really need to be getting growth that is considerably higher than 4%. So 5%, 6%, you need to be pulling that in on an average basis. Now, granted, you may have some years that are going to be lower, you may have a loss. And then other years, you're going to have a really high growth. It may be 15, 13, 18%, 10%. But over the average, over 5, 10 years of growth, that average should be running you somewhere around 4.5, 5, 6%, somewhere in that range, so that you're able to exceed the amount that you're withdrawing. That's also important because you want to make sure you exceed inflation rate as well, if you want to be able to continue to afford the goods that you're going to have for daily living. So saving is vitally important. There's several aspects. Again, you want to be saving for your emergency fund. You're going to want to be saving so that you set aside spending cash for those things that you're going to plan in your budget for. You're going to maybe going out to eat, maybe you're going to get something to drink, maybe have some entertainment. You're going to want to plan those things in your budget, so you don't do it spur of the moment and splurge, and then you get in the habit of doing that and you wreck your budget. You want to stay disciplined so that you can spend less than what you make over the long term, so that you can put that money into buying your financial freedom by buying assets that produce cash that can make it possible so that you can one day walk away from your job. Now, here's the good thing. If you're saving for the purpose of growing your assets so that you can grow your income and and achieve financial freedom, and you do that over the long term, that means that you can indefinitely grow your income even through retirement. You do not need to have your income going down. You can actually make your income continue to go up even through retirement. But it takes planning, it takes intentional action to over the long term, and it takes discipline. These are just some of the principles that outline how you can do that. We'll get into more of that in some future videos.